Hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our very good friend, Sam Clement. Sam, say hello.
Hey, John, how are you doing?
I'm doing very well. I'm kind of excited today.
I,
I'm real excited about doing part 3 of our new normal series.
I am. It's been it's been a good exercise so far, going back and looking at our predictions and our thoughts, in the midst of it, and now, in the late innings of the pandemic, and seeing how many were right, how many were wrong, and just taking the tally.
It's absolutely right. And as Sam said, what we're doing here with the series is going back and taking a look at some of the predictions we made in May and June of last year, when the lockdowns were really kind of in force and we were kind of trying to figure out what the new normal is going to look like. And here we are 10, 12 months later on, really in a lot of ways, trying to see what our predictions were. I mean, whether they were right, wrong, indifferent, or just still too early to be told. Part 1, we focused on what's going on in society. And part 2, we focused on what's going on in the workforce. And then part 3, which our good friend David McGrath down in South Alabama wrote, is about corporate response and how will corporations behave and what will the new normal look like. I'm just going to go through a couple of his predictions first. And first and foremost, I'm going to talk about something that I thought was going to be more of a slam dunk than personally I think it was. And I'm just going to read what David wrote. The COVID-19 crisis has also placed a spotlight on our reliance on China for many of the items that are now deemed of national security. There will be a renewed focus on getting many of these products produced in the U.S., or at least in countries that, with which we have better diplomatic relations, for example, Mexico. This will create a small manufacturing renaissance in the United States, and this will be important as many of the jobs that are being lost in the service and hospitality industries will not return, and those workers will need to retool their skills to find some employment. This will take some time, and one of the results will be an unemployment rate that will remain higher than many expect as we recover from the economic shutdown. Sam, what do you say about this one?
I mean, I think this is again, last week with part 2, we talked about how some of these were going to be, more long-term predictions and how they would take some time to really, take place. And I think that's very much the case with this one. And it's not necessarily an overnight thing, but I think we're already kind of seeing bits and pieces of this kind of come true and come to fruition, whether it's, Huawei, the Chinese semiconductor company, there's been a lot of pushback there and allowing the United States and Taiwan and some other semiconductor manufacturers to kind of take the helm and lead the charge there. And there's been some pushback there. So I think that's a long-winded way to say I think this could be, in the works of becoming a good and accurate prediction. But I think, it'll take honestly probably 5 to 10 years to really look back and say, okay, did we, lessen our reliance on China or really just other countries as a whole? I think that may be the bigger thing, is maybe not China specifically, but okay, we can't have too much of our infrastructure, leaning on one specific country because there's a lot of, geopolitical risk there. So I still feel pretty good about this one.
I still feel pretty good about it long term. However, I'm just going to read you some of the numbers from last year compared to 2019. I would say we got this partially right, but it's still too early to tell. In 2019, our trade imbalance, goods only, not services, but goods only trade imbalance with the Chinese, with the PRC, People's Republic, was negative 354 billion, 204 million. That's a lot of money. That was the trade imbalance. Last year in 2020, we shrank the trade imbalance to 310 billion, 800 million. So there was what is that, Sam, roughly about a $35 billion decrease in our trade imbalance. And we, imported about $16 billion less from the Chinese last year. So it does look like we are perhaps reducing our reliance a little bit on the Chinese, not maybe as much as you would think with all of the tariffs and all the talk about diversifying product lines and supply lines. However, unfortunately, when you take a look at our entire trade balance, the entire trade balance last year actually hit an all-time high, where we were running a trade imbalance in goods only of 904 billion, 940 million. Sam, that's almost the size of a relief package coming out of Washington. Your thoughts on that?
I mean, almost half the size, I think, is more accurate with the new one coming through. But no, I think that's kind of a good point, and kind of hits at what I was trying to mention. My second point being that maybe it's not as much about China but more about, or one country rather, and more about, diversifying our trade and where our deficits come from. And I think anecdotally, I think you and I are both probably thinking of a few people that we know that have intentionally diversified away some of their supply chain from specific countries. And I think that's going to probably continue to be the case. People have probably, some have learned a hard lesson about kind of putting all your eggs in one basket.
What is kind of interesting, Sam, and I'll tell you this, this is, we have, is how it's kind of played out. And with trade with China, our trade surplus with Macau went from $468 million in 2019 all the way down to $81 million last year. And our trade deficit with Hong Kong, again, another PRC territory or province, or I don't know what they call it, that also shrank last year. And so, and then furthermore, it seems as though a lot of other Asian countries were benefited by this. I think their trade
Indonesia.
Indonesia, our trade deficit with them increased. It really increased with Vietnam. And then also after years of maybe slight improvement, it also went up again with the South Koreans. So, we're not there yet, but it does seem as though we are trying to diversify at least a little bit away from China. Not quite completely there yet, but then again, let's face it, it takes a little while for that type of stup to happen. I mean, it really does.
Yeah.
It's not going to happen overnight. So you're right on that. All right.
Supply chains are pretty slow moving. You can't overnight say, I'm going to go from like the Guangdong province of China and, move it over here to Alabama in 1 year. It's not really how it works.
You've got to build a production facility. You've got to build the distribution. You got to do all that bad stuff. So, all right. Well, that's number one. I think we've given mostly true. I think it's okay. It's still too early to tell.
Yeah.
So
too early to tell.
So the second one is, in a trend that has been in place for quite some time, the demand for skilled workers remains high with low unemployment rates and much higher wages than the lower educated unskilled workers. This transition from service jobs to manufacturing jobs will exacerbate the situation. The large pool of unskilled workers available to fill any new jobs created will keep wages low, while increasing demand for the small pool of skilled laborers will allow for above average wage increases.
That's kind of a tough one, because there are some, unskilled labor jobs that have probably been decimated. But on the other hand, there's been some that have been just a massive boom. I mean, I think of, the $15 an hour Amazon jobs, and they cannot hire enough people. They truly cannot find enough people to fill some of those jobs. And they're probably not the only one. There's lots of, e-commerce and large companies that truly cannot find enough people. And so I think to me, maybe the better way to look at it is on a sector by sector basis than necessarily just looking at unskilled versus skilled labor, because it's tougher than that. I think that's too broad of a way to look at it. Retail, restaurants, some things like that are going to get hurt more than a company like Amazon.
Well, I think you're right in a lot of ways. However, I would also say that, this is just what happens during an economic downturn. What did I say? Turn down? During an economic downturn. That's just what happens. Those with the least skills, the least marketable among us, will lose their situation. To use a Dickensian sort of term, they will lose their situation first, and that's just intuitive.
Yeah,
you're not as productive, you're not as marketable, you're not as skilled, you're not as needed in the economy by definition, and so those people lose their jobs first. So I hear what David's saying. I think this is right. I think it's always the case. It's not necessarily due to COVID-19, but I also agree with you that a lot of the jobs that we lost last year, and still haven't regained a whole bunch of them back yet, are due to a lot of the economic lockdowns and restrictions that some of our larger state economies have placed on its citizens. If you take a look at California and New York alone, those two make up a disproportionate percentage of insured unemployed people in the United States, as well as having official unemployment rates much higher than the national average. Yeah. So even in absolute and relative terms, those two states which have locked down their economies the most have really suffered the most. And so it's not surprising that You're seeing a lot of jobs, a lot of these jobs that you mentioned, retail and leisure and hospitality in these states just absolutely vanish.
No, I mean, I couldn't say it better. And, we've talked about the K-shaped recovery, and that's really going to continue.
Yeah. So I think he's mostly right about this, but then again, I love David. Well, I mean, normally.
As a friend.
I love David, but I think this is a prediction that, is a pretty safe prediction.
Yeah.
Pretty safe. Pretty safe. So he gets an A+ on this one. All right. The next prediction. This is focusing solely on the restaurant industry. Restaurants, on average, they're not a very high margin business. The reduction in capacity, forced compliance with new safety regulations, and potentially lower demand will make it difficult for many restaurants to survive. The buffet style restaurants will be forced to completely rethink their business model. Sam, your thoughts?
Yeah, I'd like to think this is the case, and there's probably some numbers that back this up, but then you see companies that are restaurant groups, specific publicly traded companies pushing all-time highs. And so the market doesn't seem to think that they're going to have too much of an issue, apparently. So it's kind of a conundrum. The total market is like, hey, they'll be fine. They'll get over it. They'll probably trim down a little bit and be a little healthier, as I guess their thought to it. But then you're seeing restaurants close, or at least I'm anecdotally seeing restaurants close. And it's hard for me to not imagine that that's the case with a lot of these, very low margin restaurants that require tons and tons of turnover to be profitable, for them not to be hurting really, really bad. And especially in some of these places with, 25% capacity, where you cannot turn those tables enough to become profitable. It's almost like a death sentence. 25% is almost worse than 0%. So I think that's going to continue to be the case.
Sam, I think you hit the nail right on the head on this one. And I do think some of the larger sort of restaurant chains, I think Darden and Brinker, a couple that you're kind of alluding to, their stocks have rebounded nicely, as investors believe that once we get back to the new normal, or some sense of normalcy, people will go back to eating at Olive Garden and yada, yada, yada. I would say a lot of the restaurants that I've seen shuttered up seem to be more of the kind of local chain or the mom and pop, where the business owners or the company doesn't have quite the resources or the access to credit in order to keep the doors open. And you're right on that 25% capacity. If you're only generating 25% revenue, even opening up with 25% capacity, you're probably opening up with about 50% of your costs.
Yeah.
And so
there's a lot of fixed costs.
A lot of fixed costs.
And it's just, and what you mentioned is probably pretty spot on, that the difference between the larger chains and some of these smaller ones that are closing is access to capital, I think, and the cost of capital. The weighted average cost of capital for a company like the Darden Group is going to be a lot less than, a company with a similar business model, but one or two locations, and them having to go out to a community bank or a small bank and try and get a loan to cover the cost. So I think that's really kind of the difference, not necessarily the business model between who's closing and who's not, just who can survive, who can get a flotation device to get them through this. So I think you're pretty spot on.
Yeah, and trust me, I don't think the people at Darden are applauding what's been happening over the last 12 months. I bet it's been painful as all get out to them, but they will probably come through on the other side once we get back to 50% capacity or 75% capacity. And then David's prediction about buffet chains, buffet style restaurants, that they might have to rethink their business model. I don't know. I mean, I'm not exactly sure. I like a good Chinese buffet, as you well know. However,
I do know
that. Lord knows I've made you go to a couple of them. However, like take something like a Golden Corral or something like that, a Ryan Steakhouse. Is that business model going to completely go away? I mean, a lot of this is going to depend on local government edicts and mandates and ordinances about buffet style dining. I just have a hard time believing if we get back to where, okay, you can go back to the buffet, whether or not a place like a Golden Corral or some other sort of smorgasbord, if I were up in the Midwest, that business model is just all of a sudden no good anymore.
Yeah, I think, and this is just my thought, I don't really have a ton of data to back it up, but I think those kind of companies and those kind of restaurants that you're mentioning, I think where they're gonna change is maybe the total locations that they have, realizing, okay, maybe some of these we can go ahead and clean up and kind of use as an excuse to shutter it down and roll into our more profitable ones. And there may have been times where these chains were more successful and more locations made more sense, but that's probably the difference I think we'll see is maybe some reallocation of capital for some of these companies into their more profitable centers.
Well, the thing is, the reason why buffets make sense, particularly like in Chinese restaurants, is due to the fact that it just cuts down on the number of people that have to work there.
Yeah.
You don't have as many wait staff. You don't have as many front of house workers, and so that's the reason why so many Chinese restaurants are buffets, because they're cheaper to run. And I do think that we'll probably see some decline in them, but the people that are going to a Golden Corral, Lord knows I've been one of them on a few occasions. People going to Golden Corral really don't care that much about contracting COVID-19. I just really don't think.
That may have been where it started.
It's comfort food of the lowest common denominator. It's tasty, but you really kind of feel as though you've given up after you've eaten it with one of those places. And listen,
put your hoodie over your head while you walk out.
Listen, this isn't to knock the Golden Corral. We don't make a market in any of these names and anything like that. We have no vested interest, either directly or indirectly, of any of these companies that we've mentioned here. Just talking about the business models. All right, next one, going to retail. The continued trend towards online shopping places more and more pressure on the traditional brick and mortar retailer. The demise of the mall concept will be set into overdrive, and foot traffic will not return to the pre-pandemic levels. Your thoughts?
Again, stocks are kind of disagreeing with this. I mean, Simon Property Groups, look at a lot of these other, commercial real estate companies, or, ones that own a bunch of shopping malls, and they're rocking and rolling. Their stocks at all-time highs. It's like nothing ever happened to them. But it's hard for me to disagree with this thought that these aren't, I mean, anecdotally, we're seeing malls close around here, and, people aren't going to them. They're being repurposed as apartments or whatever they're talking about. And this is something I think I probably disagree with what the stock price is saying. And again, the same caveat that we don't make a market or any of that with any of these securities, but it's hard for me to think that the stocks are right on this one.
I think it could be a weird situation where everyone's right. I think David's right about his foot traffic, and I also think maybe the stock market's correct as well. Now, with some caveats here, I would say that what has happened with bricks and mortar retail over the last 12 to 18 months, and particularly with the COVID-19, is, as Sam, we've said this a lot in the series, we've just expedited the inevitable in a lot of ways. And a lot of malls, and the malls that we see struggling around here, in which you probably go to any mid-major, even major metropolitan area, they do the same thing. The malls that are struggling are those where there's just an enormous duplication of effort in the local community. It's there's another department store, the same brand. They're just 3 or 4 miles up the road, selling the same thing at the same price points. So I think that that reports of the demise of the shopping center or the shopping mall maybe a little bit exaggerated. We're not going back to the 70s and 80s and the highlight of it by any stretch of the imagination, but I don't think they're going to completely vanish. There are some people that just simply like the ceremony of going to the shop, but what we will see is undoubtedly fewer shopping centers. And so I think he's mostly right on that. And I think what the investors are saying is, okay, this pandemic is what the healthy, or reasonably so, retailers needed in order to come to grips with their fixed costs and start right-sizing their balance sheet. And that's kind of what I think investors are anticipating.
Yeah, no, I agree with that.
All right, and then the final one we're going to touch on. Final one. This on the real estate. The change in the retail sector, combined with the sudden realization that a significant number of people can work remotely, will have an effect on the real estate industry. By this, he's talking about commercial real estate. We are not sure how much of the workforce will be asked or will request to work remotely when we are past the current pandemic, but it will not be 0%. And we kind of touched on this in section 2, talking about remote working and all that, about the workforce reset. But what does it mean really ultimately for commercial real estate? And I'm going to take this one first because I've made a few presentations thus far this year to commercial real estate groups. And I would say what this probably means is the demand for additional capacity of, say, a B-level office space probably just not there. Probably not going to build a whole bunch of grade B or grade C sort of facilities. Just not going to do it until we figure out exactly what we have going on here. However, the right project at the right price point and in the right location will still get done. And then what we'll see in commercial real estate, particularly office space, is what we'll see is maybe not the addition of new capacity, but we're going to completely rework a lot of the existing capacity to reflect the new normal and an increase in remote workers. For instance, here at Oakworth, we might reconfigure how our office space around here, have some common offices and the like. Traditional bricks and mortar retail. What's kind of funny is Amazon, the big bricks and mortar killer, is actually putting up more bricks and mortar than any other retailer out there. However, that's more an industrial space. I think retail is going to struggle for a while, negative absorption in that area. However, distribution and industrial warehouse space, all that good stuff, that should continue to do pretty well. So I think that's a kind of a mixed bag with real estate. Don't like the overall sector. I think it's you got enough headwinds where I think investors will be able to make more money elsewhere, but the complete death knell scenario I think might be a little exaggerated.
Yeah, I think there's always going to be some need for brick and mortar and CRE, and I think it what you hit on for a second about repurposing and making it smarter is really going to be the avenue forward, and those that are able to kind of pivot are going to be the ones that are successful, and those that aren't are going to be the ones that aren't successful. So I think that's kind of how it's going to play out, instead of like you mentioned, a complete demise of the real estate industry. So, and I tend to agree with you. It's hard for me to get too excited about investing in real estate. It's I think you put it best. I mean, there's probably better places to put your money to make money right now. So
and anyone in New York or maybe even San Francisco listening to say, what the heck are these two rednecks talking about? Take a look at vacancy rates in some of the larger central business districts. And like we mentioned in part 2, there's other extenuating circumstances there. Higher taxes, kind of bad economic policies, more restrictions during COVID-19, a lot of stuff is in play there. Whereas you can go to a Nashville, you can go to Austin, you can go to Charlotte. Yeah, we've all had our troubles really with the pandemic, but you'll need capacity increases in real estate when people are moving into your area. So if you see an area with population growth, the commercial real estate will probably be pretty decent there. Those areas where you're seeing population declines, that's where your commercial real estate is going to struggle the most. It's kind of 2+2 type stuff.
I agree. Easy enough.
Easy enough. So all told, I'd say David did a pretty good job. Just like you did a real good job. Actually, I think we agree that you did a real good job with the workforce reset, and I did just a pretty good job with society as well. So, I mean, this is our Gen Z is really kind of cranking it out, whereas the Gen Xers here are just really kind of falling by the wayside. I mean, maybe that is trading perspectives. Your thoughts on that, Sam?
I don't know if we're trading perspectives here. I think you may
agreeing with that.
I think you may have had the harder topic.
I just make more predictions because I like to have an opinion. As I've told anyone that will listen, once I go home, guess how many opinions I get to have?
0.
That's right. So guys, thank y'all so much for tuning in. We always love to hear from our listeners. So you by all means, drop us a line at tradingperspectives@oakworth.com. If you're interested in reading more, hearing more of what we have to say, by all means, please go to oakworth.com and take a look underneath the Thought Leadership tab. All kinds of good articles and whatnot there. All right, Sam, I'll give you a last shot.
That's all I got.
That's all I got today too. Y'all take care.